So if you look at the price to earnings ratio, you make a decision if a company falls in the value-based category or the growth-based category. If the price to earning ratio is less than the industry average of P to E ratio, price to earnings ratio, or the sector average, that is a price to earning ratio, it may give an indication that we are talking about a value-based investment. So the company, all else being equal, the company is a great company, everything is fine, but perhaps the market is treating this company unfavorably. So the price is less than what it should be. So you buy it, wait it till the price goes up. And when the price goes up, sell it and have the capital gains. On the contrary, the growth-based strategy is opposite. Then you buy the stock whose price to earnings ratio is higher than the industry average or the sector average, because you are expecting the price to go up further, right? So you are buying expensive than the average in case of growth-based strategy, whereas in the value-based strategy, you are buying it cheaper than the industry or the sector average. But the thing which I want to show you here is that the numerator of this indicator is price, and the price is a stock price, okay? And the denominator is earning, and here the earning is earnings per share, okay? Now here, if you look at the numerator, can I ask you one thing first? If you want to check a company's performance, the financial performance, which are the main two channels or the methods which help you to know if a company is growing or not growing? Yes, you raised hand. Yeah, but I'm talking more in philosophical terms, that if you look at the price, stock price, is stock price an accounting information or the market information? Have you seen the company's accounts? Yeah, did you? I showed you last time. You see the company's stock price in the company's annual report or not? No, because the word is annual, that is updated after a year. Whereas the price moves every second, every minute. I think I showed you last time on finance.yahoo.com that look at the stock price, it's changing after every 5 seconds. There's a flash coming up. The green flash is the price going up, the red flash is the price going down. So if you see the numerator, it's a market information, is it? But look at the denominator, the earnings per share. Where does it come from? Earnings per share, where does it come from? Which earnings? Net profit. How do you get the earnings per share? Well, you have the net earnings of the company divided by the number of shares it has. But here, which earning I'm talking about? Accounting or the market earnings? Accounting. So this indicator is a very, very important indicator, because the numerator is symbolizing, is reflecting the market information, whereas the denominator is reflecting the accounting information. So price to earning ratio indicator is a hybrid. You know the word hybrid? Is a hybrid indicator. It's partially market, partially accounting. And what is the difference between accounting info and the market info? The market info is forward-looking, futuristic. Whereas the accounting information is historic. Do you know the difference between futuristic and historic? When the stock price of a company goes up, it gives an indication to the investor about the future of the company. The future is good. So the price movement, the stock price movement, is a futuristic indication, whereas the accounting information is historic. You look backwards, you go in the history, you go in the memory lane, and then you find, hey, last year, 3 months ago, 6 months ago, this was the earnings of the company. So the price to earning ratio today, you are looking in the future as well as looking in the past. So price to earning ratio is covering all the three dimensions of the time: past, present, future. Today, you're looking into the future. You're making when you look at the numerator, the price goes up, the price goes down. You can make some sort of assessment about the future of the company. And when you look at the denominator, it's all historic. So it's a very strategic indicator. It's not the final indicator to decide if a company stock could be labeled as value-based or the growth-based. It's a very preliminary investigation, right? But if you make a right choice of your preliminary indicators, you are on track. But if you make a mistake, then you are wrong. So if you are an analyst, then it's not a bad idea to start your investigation from price to earnings ratio indicator. So important is this indicator. Does it make sense? So we learned that the numerator is market performance measure. The denominator is accounting or the bookish or the historic performance measure. The numerator is forward looking. We see into the future. We can see some kind of the future growth of the company or deterioration, whereas the denominator is telling you something about the company's past. Okay. This question is very important because it tells you that how the macroeconomic developments have an impact on the stock market and how you can link them both. Just before I came to your lecture, I was talking to my colleagues, and we were talking about a very famous investor called Warren Buffett. Do you know him? Warren Buffett is an old man. He's a millionaire, if not billionaire. I think he's a billionaire. He is. Yeah. And his characteristic is that he's the only person on this planet Earth who have beaten the markets consistently than anybody else. If you choose to play some investment games and you make some artificial portfolio and you are playing with the market just as a dummy, just as a prototype, you may beat the market once, twice, 3 times, 10 times, but you can't beat the market all the time, believe me. He's the only person who has beaten the market consistently by a very big margin. And I was telling one of my colleagues that the one characteristic of his investment strategy is that he invests like an economist than an investment manager. You get my point? If you're an economist, when you see the situation that is the economy, is this company going to do? Remember, the companies are in countries. If the countries are doing bad, giving a bad performance, how can the company in that country grow? So what he does, he not only looks at when he makes a decision to invest or not to invest or divest, he not only look at the company's performance or just the stock market performance, he even look at the per capita income of the country and the GDP growth rate or the fiscal deficit. Now look at the word GDP growth rate, fiscal deficit, the rate of interest, the expected inflation rate. They are the words, terms you study in economics, not in finance, but he's the one who assesses them, who evaluates them. And then based on these macroeconomic indicators, he make a decision to invest, divest, or not invest. Invest means you invest, the money goes out. Divest, you invested, you sell it, take your money back. Not invest, you have money, you choose not to invest. Make sense? So these are very strategic decisions, and these becomes even more strategic when you are not investing your own money, but you are investing. You are managing a fund. You know the fund? Where people pool their resources and you are investing on their behalf. So at that time, your responsibility becomes even more crucial, that you can't cheat, uh, you can't show your negligence to the others' funds, because if you lose, then several people would lose, and they can lose even their hard-earned savings for the whole lifetime. So the stakes are very high in that case. Okay. So look at this example. In this example, it's a very basic, rooted example. But the good thing is that here you can see the stock market performance vis-a-vis the macroeconomic performance. All right. Now I show you something. Suppose that, well, I can show you like this. Suppose that there are three possible scenarios in the economy. I'm talking about economy, not the company, remember, okay? So I'm talking in more macroeconomic scenario. There could be recession, normal growth period, or the boom period. What are these? Recession, normal, boom, what is that? What is recession? Which crisis? What are, give me the indicators. How do you see the recession? Give me the very visible features of recession. Huh? What happens in recession? People are not buying and selling. The market is slow. Well, the most visible thing in recession you see is that people are losing jobs. Nobody is willing to buy anything. If you have cash, you stick the cash to your chest. You don't want to give away because you think that the money is so precious here. I don't want to part away with the money. Hold the money. You're not willing to spend money because you're so scared. You think that, hey, I think all hopes are lost. Where should I invest in? The companies are not worth. The profits are going down. The stock market is going down. There is a financial destabilization. There are economic uncertainties, and there could be even political uncertainties. How can you have a booming stock market when the political crisis is looming on your head? Imagine there's an army coup in a country. Do you think that the next day the stock market will go up? Of course not. So this is recession, right? And then we have the boom time. The boom time is when the demand is going up, the factories are producing output day, night, day, night, day, night, three shifts. They're working even on weekends. People are getting jobs. There's a shortage of labor. You even employ labor from outside. You get the wage hike. You think that I think I should sleep less and work more so that I can earn more. There's an opportunity cost. The employer is luring you, hey, do you want to sleep 1 hour? Or do you want to take 3 times more wage? And you think that, how? Sleeping is so expensive now. You get my point? So there is a cost. So what happens then? Things are getting better. And the world has seen, if you look at 1990s, I think most of you were not even born then. If you look at 1990s, ask your mom and dad, they will give you a better idea. The world has seen this kind of boomish time during 90s. 1990s was a fantastic decade. And then we have some sort of normal growth. Now we say that yes, even though many people, detractors, are still saying that we are still not recovering from the recession yet. But many countries, you see that there is some normalcy is restored. Economic. American market is doing pretty good. I think many European countries are doing pretty well. Asia is doing pretty fine. China, India, Australia, they're doing a pretty good job. So in the major economies or in the major emerging economies in the world, things are not so bad, even though the clouds are hovering on your head. But situation is not so dismal as it used to be. Okay, so this is the situation. The reason I'm discussing all these things is that I want to bring into your knowledge that how important is the macroeconomics to study finance, right? So the idea is that these numbers are a bit exaggerated, but the idea is more important. That if there is a recession, the economy, the stock fund will go down by 11%. If there is normal time, just average, uh, the stock fund will grow 13%. And if there's a boom period, the stock fund will go 27% up. So these are the numbers. These are the estimates given by the, who do you think would have given these numbers, by the way? Is some astrologer has told these numbers? Do you think there's some astrologer, you know the astrologers? Who looks at your hand and tells your, the lines, and then they tell on the forehead, and then they tell you that, hey, it looks that in the future you will become this. Huh? Who has told these? Who has given these numbers? Huh? History? Some analyst. You know the analyst? Do you know the analyst? The analysts are the people, or the economist. Well, in this case, it will be economist or the analyst or both. They have some economic forecast. They're making forecast, but it's not speculation. They do, you're right, Nadia, that they look at the historical data, and by analyzing the historical data, they make a forecast for the future. And they are making these numbers. They're cooking up these numbers, okay? Now, here, you see. Yeah. And then, if you choose not to invest in the stock fund, but in the bond fund, then you get 16% in recession, 6% in the normal time, and minus 4% in the boom time. I want you to notice these numbers, even though, as I said before, these numbers are exaggerated, but they are telling you a story. And this story would have not been told had these numbers been not so much exaggerated or inflated. Do you see something? Do you think there's a mistake in the numbers here? Bond fund. You know what is bond? Is it an error that it's minus 4% in boom time? Or does it go with the reality? Please tell me. Bills are for the short time. Bonds are for the long time. Yeah. Bills are, remember I told you that if the normal definition of a bill is that this debt is a debt. First of all, bill and bond are debts, not stocks. They're not shares. They are the debt. You lend your money to somebody. If you lend your money to somebody for less than a year, it's a bill. If you lend your money to somebody for a 365 or more days, it's a bond. But anyways, bill or a bond, it's a debt you give. When you give a loan to somebody, it's a loan. So you're lending your money to somebody. You're a money lender, but you're not an equity investor. Yeah. In the recession, nobody is willing to give loan. Is it what you mean? Well, actually, on the opposite, in the recession, the banks are flooded with money. But it's not the supply problem. It's a demand problem. People don't want to borrow. I think I gave you an example of Japan, that country had negative rate of interest for many, many years because despite offering the negative rate of interest, the investors were so pessimistic, they lost all hope in the Japanese economy that they were not preferring to borrow anything from the banks, even though the rate of interest was negative. Look at the negative interest rates meaning. If the negative rate of interest, as in this case, let's say is minus 5%. So basically, the bank is saying that take 100 euros from me today and give me 95 at the end of the year. So this is what banks is doing to motivate you to borrow, but people still don't borrow. The reason here it's minus 4% is logical and reasonable, is that if there is a boom period, why would you not invest in the stock fund then? When the market is flourishing, why would you invest in the bond fund? And people will not do it. And because there is no investment in the bond fund, hence the rate of return is down. Whereas in the recession period, look, 16%. Because in the recession period, people are not investing in the stock fund because the stock market is so pessimistic. And then people divert their resources in the bond market. Therefore, don't get surprised if the bond fund and the stock funds are trading going opposite direction. Make sense or not? Imagine there is a recession time and I have some surplus money, savings with me. I have a choice. Should I invest in the stocks? Well, I don't want to invest in stocks because the market is so bad. Situation is so negative. Stock market, if today I invest in stocks, tomorrow the value will go from 100 to 90 to 80 to 70. What will we get at the end? Because the stock market is crashing in recession. Then what I do? Then I say that, hey, you know what? This bond fund, at least I would be getting some certain fixed rate of interest. It could be very low rate of interest, maybe 1%, 0.5%, but still I would be getting something. So I put my money in the bond fund. And what happened then? When the price of the bond goes up. Do you get the point? I think you haven't got the point yet. I'll tell you something. Imagine I have 100 euros in my pocket and there's a recession. There's a fear that if I invest my 100 euros in the stock market, I would be losing my money. Then what should I do with my 100 euros? Should I keep in the pillow? No. Then I find that there's a bank, there's a treasury bill or a bond offering 1% rate of interest. Then I say, okay, fine, something is better than nothing. Okay, let's invest in the bond. When I do it, you do it, the same way of thinking, the same line of thinking, then many people would start investing in the bonds. Remember, bond not only give you interest, but the bonds have the price in the market also. Because many people are buying bonds. As a result, the price of the bond will go up. And then even there is a recession by selling bond expensive. You know, I'm the first one to buy bond. You followed it later on. By the time you bought the bond, the price of the bond went up. Okay, when I bought it, it was for 100. When you came in the picture, it was 104. So I'm selling it to you for 104. And thus, despite recession, I'm earning. This is the logic. And on top of that, I also earn the interest rate. Right? So therefore, even though these numbers are too much inflated, but the story is logical. All right? Now, let's see what happens next. Why it doesn't work? Look at the second column. The first column is the scenario. So there are three scenarios, yeah? Recession, normal, and the boom time. And the probability, the economist or the analyst, they have a probability. They think that there are 30% chances, 0.3 probability that there would be recession. And there's a 40% chance or 0.4 probability that there is a normal time. And there is a 0.3 or 30% probability that there'll be boom. Now, the rate of return, look at that. Look at the C column. Yeah. Remember, I told you before that if recession, it's 11%. If normal time, 13%. If boom time is 27%. And then look at the E column, the bond fund. Yeah. The bond fund. And there is a recession, 16%, 6% normal, -4% boom. These numbers I just copied from the statement. Okay. But I haven't explained you column C and column E. Column C is the product of column B and C. Sorry, column D. Column D is a product of column C and column B. So I multiplied probability with rate of return -3 multiply -11 -3.3. So I'm 0.4 multiply 13, 5.2. 0.3 multiply by 27, 8.1. And when you add them up, guess what? Expected return on stock fund is what? 10%. So you can make an educated guess that if we keep into account all the three economic situation, then on an average, you know the average, you know how to find the average, come on. That you have a variable and the frequency, and then you multiply both and you add it up, yeah? And then you find out that the average means expected rate of return. And this is not you're doing after 1 year. No, you're doing it in advance. You hope that recession is 30%, normal is 40% chance, and all that. And then these are the rate of return historically determined. And then you multiply them and you find out that the expected rate on stock fund is 10%. And then the same thing you do for the bond fund. So in the bond fund, you multiply E with B, 16 times 0.3. Sorry, I should have said something. It's not C with B, but it's E column is basically, or F column rather, is your column E multiplied by column B. So 0.3 times 16 is 4.8. 0.4 times 6 is 2.4. 0.3 times -4 is -1.2. And when you add it up, it comes out to be 6%. It means that overall, you expect 10% on stock fund and 4%, 6% on the bond fund. This is the basic calculation. It's simple arithmetic. Yeah? Make sense or not?
What do you find this number? I mean, it's an example for the number of the percentage of the
Well, if I tell you the story is that if you work for McKinsey, for example, a consultancy company, yeah, you are making some forecast about how the economy looks like, and then you make an estimate that there's 30% chance that there will be recession and 30%. So you make some kind of forecast. So this is not a reality. Remember, this is not something, it's not ex post, it's ex ante, it's before things happening. And this is prediction. But this is not a fluke. This is not a speculation. People who have done these calculations are really pro of their field. They're really professionals who have done this work. But again, there's still some uncertainty element, So there is a hope that things will work what people are expecting. They're hopeful. And when you work for a consultancy company and you give these kind of estimates, you also be careful of your reputation. If you do these wrong numbers 1 year, then the next year, nobody will trust you. All right? So it's not fluke, it's not random numbers. These are, even though they are for the future, but they are very carefully calculated. Okay? Yeah.
So if you put these are all,
it's all forecast here.
So for example, the 100 euros there think it's going to be a recession, then you will lose in your stock 3.2%. So then you
Yeah, yeah.
But if you expect there becomes a recession and you invest in a bond fund,
Mm-hmm.
you will get 4.8%.
Mm-hmm. Yeah, I'm coming on this point. And remember, this 10% means, this 10% is, if you look, this 10% is calculated vertically. So this includes all three economic situations. But this 10% means that you are only investing in the stock fund. So this 10% means that if you invest all your money, 100% wealth in stock funds, then okay, there could be economic recession, boom, whatever, but on an average, you'll be earning 10%. And if you are investing all your money in the bond fund, then despite all the economic situation, the average forecast, remember, these numbers are always average. You can't have an economic forecast for each person. It has to be for the whole economy or for the whole sector, yeah? And that comes out to be 6%. Now the story is not over yet. The story says that the story tells that uh, you don't invest all your money either in stocks or in bond. You create a portfolio. And the portfolio is that you choose to invest 60% in the bonds, in the stocks, and 40% in the bond. What would be your expected rate of return in the recession period? So the question is that you're not investing all your money in stocks or bonds, but you make a 60-40 combination, your portfolio. And here you only want to focus, concentrate on recession. That if imagine that it's not recession is not no longer probable, recession has arrived, what would be your rate of return? Well, you're right. When there is a recession, you lose 11% in stocks and you get 16% in bonds as per the numbers, yeah? And how much you invest in stocks? 60%, look, 0.6. And you invest 40% in the bonds, which is 0.40%. So if you multiply these two numbers and make a sum, it comes out to be 0.20%. It means that there's a high likelihood, if you are an analyst, now see what, we move from macroeconomic to microfinance. So now you are acting like, now you're no longer economist, now you are a financial advisor. Some client is sitting opposite to you and you're telling the client that, hey, if you invest 60-40 in stocks and bonds respectively, then I can say that there's a high chance that in the recession, you would be losing 0.2% wealth. And then the next question of the client would be, hey, is any way I can gain despite recession? Then you tell your client that I think you should change the weights. So instead of 60-40, you can try 50-50 or 40-60, right? Here comes the consultancy. So now you have accepted those numbers, and now you are giving an advice to your customer that, so you are a wealth manager of a rich footballer or a Hollywood star, and he's asking you that how to invest money, imagining that the recession has come. So then you are giving the advice that I think we should change our portfolio. We should put more weight on bond fund and less weight on the stock fund. Sound sense? Yeah. So in the recession, as per the given portfolio, you are losing 0.2%. Now try one more portfolio by yourself. This time, yes, you will do it by yourself now. This time the stock fund is 40% and the bond fund is 60%. Try, play with the numbers, and tell me very quickly, very fast, what is the likely expected rate of return? 40-60. Oh, 40-60. 60, 40 in stocks, 60 in bond. Let's see. 5.2% positive. Yeah. So you can say that if you change weight in the portfolio, you completely swap the weights, then you are likely to get 5.2% in the bond fund despite there is a recession. Yeah. Now the same thing. Now look at your task one. I told you that in this course, whenever there is a red thing, yeah, there would be task. And the first task has arrived. And what is that? The way you calculated the portfolio return in case of recession, now do calculate for normal period and for the boom period, right? Do make this calculation for the normal time and for the boom time. That you do by yourself, okay? Not now, at home. Yeah, in Excel, yeah, because all your tasks, as I said before, that when you will be making presentation here, you bring a master's Excel spreadsheet, task 1, task 2, task 3. And I told you that just numbers calculation is not enough. You need to make interpretation of those numbers as well. So whatever text you want to write, you can write within the spreadsheet itself so that you don't have to switch between different files. Make sense? Do you have any doubt? Did you listen to what I just said? Huh? When you prepare your group tasks, prepare them in the one common spreadsheet. You know, in the spreadsheet, you can have sheet 1, sheet 2, sheet 3. Name them also. I will be very angry if I see sheet 1, sheet. No, write it task 1, task 2, task 3. Rename them. Okay? And then do all the calculations in the spreadsheet. And just calculations are not enough. The most important thing of the task, the spirit of the task is how you draw some conclusion. You know, you get some lesson from that. And how you express that lesson in words. You write those words also in the corner of the spreadsheet, so that you don't have to open Word file or PowerPoint when making presentation. Everything is in your spreadsheet. Okay, the first spreadsheet should be containing your the group members' names, so that I know that who are the group members. So that, because if you send me the spreadsheets without writing the names, then how would I know who's who? Okay, so write the names of the group mates as well. So do it for. I've done one for you for the recession period. Now you do it for the normal period and for the boom period by yourself. This is the formula, you know it very well. You don't have to worry much about it. I think this is just given as a theory. Correlation is very important. You know the coefficient of correlation in statistics? How many of you have studied correlation in your previous life? Huh? Did you study statistics? Who have not studied at all? You didn't study? Look, the correlation, I can explain it right now, yeah? The correlation coefficient tells you the degree and direction between two variables, right? The degree and direction between the two variables. Now imagine, I take a company or multiple companies, yeah? Imagine I write one data of advertisement expenditure. Company A is spending 1 million, company B is spending 1.2 million, and I have a column. And then the second column is the sales revenue, right? And then the sales revenue figure is there. And when I calculate the coefficient of correlation, it comes out to be 0.6%, 0.6, not percent. It comes out to be 0.6. Imagine, yeah? I'll show it by right now. But I'm just giving you some examples. 0.6. It means that 60% movement between the two variables is common. It means that you can say that when advertisement moves by 1%, there is a 0.6% movement in the sales revenue also. So the movement between the two variables is 60% together. So this correlation shows that how much two variables are going together. Have you seen, did you study economics? Did you see law of demand? The price goes up and the demand goes down. Can I say that if in a city, let's say in Uvascula, if the state spend more on education, imagine that the state is spending more money on more education, better education. What do you think will happen to the crime rate? Well, we don't have much crime rate in Uvascula, but I'm just asking you, what do you think will be the impact? If the state is spending more money on education, what do you think will be the impact on crime rate? Will it go up or down? Down. So I can say that there's a negative correlation between education and crime rate. Look, the word I said, there's a negative correlation. Means if one goes up, if the education expenditure drops, the crime rate may rise. And if the education expenditure goes up, the crime rate will go down. This is called correlation. Correlation shows to what extent the variables mean, in this case, education and crime rate are variables. In the previous example, sales revenue and advertisement were variables. So the correlation tells you how much together, to what extent two variables go together or in the opposite direction. Look, when I gave you example of advertisement expenditure and sales, it was an example of positive correlation. Positive. Why positive? Because you expect when you spend more on advertisement, sales will grow. And when you spend less on advertisement, sales will go down. So they go up together, down together. But in the second example, there is negative correlation. You see why? If you spend more money on education, crime rate drops. And when you spend less money on education, crime rate may go up. So they go opposite direction. When they go opposite, it's called negative correlation. Okay? Now, correlation. Now you get the idea of correlation? Sorry, what's your name? Maya. Now you got the idea? This is all about correlation. Now, even if you haven't studied correlation before, you are as equal as others. This is all you want, all you needed to know about correlation. Okay? Now, correlation is very important in finance when you talk about diversification. Do you know diversification? We studied last time that if you have a diversified portfolio, yeah, you have more stocks, then your unsystematic risk goes down, basically, right? Yeah, makes sense. Remember the picture I drew like this, like going downwards and this way. Okay. correlation is very important about the quality of diversification. Imagine I have 100 euros in my pocket, and I put all my money in British Petroleum. Have I taken a big risk? Is it a big risk, you think? It's a big risk because if BP does something similar as it did in Gulf of Mexico times, I can lose all my money. Yeah? So the lesson you learned was that if you put your money in multiple stocks, then your risk goes down, yeah? Now, situation 2. I put 40% money in BP, 30% money in Shell, and 30% money in Chevron. Am I diversified? Huh? How? Well, the different companies, so my unsystematic risk is less. But they are in the same industry. If the oil price goes down, all the 3 companies will suffer. So basically, even though I'm diversified, but the quality of diversification is not so good. How do I know it? Because the correlation between the 3 companies will be very high. You get my point? These 3 companies are in the same sector, in the same, not sector, in the industry. Yeah. And if I choose one oil company, one wind company, wind power, and one solar power company, what happens now? My quality of diversification has a little bit improved. Now I expect the correlation between these 3 stocks is comparatively lesser. Because even though these 3 companies are in the same sector, the sector's name is energy, they belong to different industries. And even better, I have one oil company, one pharmaceutical company, and one, let's say, media company. So I'm investing in one oil company, BP. I invest in one media company, let's say, what's the name of the media company? You watch movies, come on. Walt Disney? Huh? Walt Disney, yeah. And the third company I invest in is Microsoft. Look at that. They come from 3 contrasting sectors. So I assume that the correlation between these 3 companies would be very less. People, so we prefer, if you want to improve the quality of your diversification, then you can assume that the correlation between the company's stock return should be as less as possible. If you are choosing 2 stocks whose correlation is very high, it's not a good choice. It's not a good choice. If you are a risk-neutral, risk-averse investor, and you are choosing the stocks, three companies in a portfolio whose return is highly correlated, come on, you made a very bad choice. Ideally, in the dream, in the wildest of your imagination, you even look for 2 stocks with potentially negative correlation. Negative correlation. Not anymore, but in the past, historically, 50s, 60s, 70s, 80s decade, the gold and oil used to be negatively correlated. So when the oil price goes up, the gold price drops. And when the oil price drops, the gold price goes up. Not anymore. We checked, last year I conducted an exercise with my students. So we saw some last 5-6 years gold prices and the oil prices. We didn't find any negative correlation, honestly. But in the past, if you look at the textbooks of finance, you will find that historically, gold and gold and the oil prices have been negatively correlated. So in a hypothetical case, if you invest in BP, or De Beers who are mining gold in Australia. Yeah. So if you are investing in these two companies, well, you will not lose. If you lose in one, you gain in another. Get my point? Huh? I think it's a matter of when the oil price goes down, the oil companies start losing money, right? People don't invest in the oil company, then they invest in another expensive metal. Look at the nature of two. They both are commodities. So people say that, hey, oil is no longer attractive commodity. All right, let's invest in the gold. Because gold, see, gold does nothing. Oil runs your car. Gold does nothing. But the thing which attached to gold is that people value it. Do you get my point? This is the same logic. This is why the people who favor cryptocurrencies, this is the main argument given by the cryptocurrency advocates. They say that if gold can be popular, what does gold do? I can imagine that when you want to use oil, you use oil. It's a very utility-based thing. But does gold does something? I mean, what does gold do, by the way? Tell me. Except that you wear it, you flaunt it, you show that, yes, I'm rich. What does gold do? Please tell me. Then why gold is so expensive? Yeah, why are diamonds so expensive? Why is silver not so expensive? The idea is that people attach some value for any reason. This is why people who are favoring those Ethereum, coins, and there's so many other metallic coins. This is exactly the logic of people who are favoring the cryptocurrencies. That, hey, why do you buy gold then? If you're so angry with Ethereum or copper or zinc or this or that, what's wrong with? Why do you accept gold then? You get my point? So that we are deviated from our example, but the point is that if you want to have a good quality portfolio and your investors are not risk lovers, then you always look for the stocks in the portfolio who are low correlated, not highly correlated. You want to see the example? I can show it to you, but I have to pause it first. Yeah. Okay, have a look at this now. If you look at the cell A1, B1, C1, you find that return on X stock, the two assets, X and Y. Historically, it's proved, as Nadia said, that you look in the past and you do some calculation, you find out that in the history, in the past, X has grown at 10% and Y has grown at 15% in the past. You took last 10 years data, imagine. SD stands for standard deviation. Yeah, standard deviation. Standard deviation is a measure of risk. If you have return, you have risk. No pains, no gains. Gain is return and the pain is risk. And standard deviation measures the risk. And if the assets are giving you more return, they would be risky as well. So you can see that asset Y return is 15% more than X, but asset Y is risky also. Asset X is 0.2 risky, asset Y is 0.3 risky. So asset X gives you less return, but it's less risky. Asset Y gives you more return, and at the same time, it's riskier as well. Okay? And remember, return, you know how to calculate return. We have done in the past example, in the previous example, haven't we? Now, what we haven't done is standard deviation. Standard deviation is a measure of Maya. Standard deviation is a measure of risk. Okay? Now, because statement, standard deviation is the measure of total risk of the company's stock return. I repeat, total risk. Remember the two kind of risks which you studied? One is systematic risk and the second is unsystematic. I'm talking about systematic plus unsystematic, both. So altogether, the total risk is measured by the standard deviation. There are many other measures, but this is the most standard measure of riskiness of a company stock. Right. Now I come back to the original example. Remember, we were discussing about the other example, not this one. Now, please tell me, are you confident that Y D2 is higher than D1? D2 is higher than D1 because B2 is higher than B1. If you are looking for more returns, then be prepared to face more risk also. This is the argument. Remember the phrase I gave you, no pains, no gains. If you want to go for more return, get ready for more risk also. Okay, now what I do here, can you see these combinations? 2, 8. This is 20% in X, 80% in Y. So A, B, C, D, E are 5 portfolios. You know portfolios? Combination of 2 stocks. Well, it can be many stocks, but in this example, I have 2 stocks. Okay, so portfolio A means 20% X, 80% Y. And the other extreme is portfolio E, which is 80% X and 20% Y. And here what I get is return. So if you have I can highlight the formula. If you want to have a portfolio, then the return would be this. Do you see the reason why this return comes from? Do you know why this return comes like this? When you look at C column, C1, C2, what do you read in C1 and C2? It says standard deviation of X, standard deviation of Y. But that means that if you put all your money in X, then standard deviation is 0.2. But if you put all your money in Y, then SD is 0.3. But now what we are doing here in the highlighted area, I'm making standard deviation of the portfolio. You know the portfolio A and B, sorry, X and Y. So that is why the way I want to find the portfolio return is in B9, B10, B11, B12, B13. Now I'm making portfolio return, which is in C9, C10, C11, and C12. And where you see this formula is very scary. Yeah. Where does it come from? Well, it comes from the slide. Where is the slide? The slide is, wait a sec. The slide is here. Okay. This is the formula I'm using. So you don't have to memorize it. You just need to apply it. But it's very simple, believe me. You know, it's not rocket science. But the point I'm trying to make is that look at the correlation here. This RXY, can you see RXY here? RXY is 1, yeah? It means that there is 100% full correlation. If there is if the DP stock goes up by 1%, Shell goes up by 1%. They are perfectly correlated. Is it good or bad situation for your diversification? Bad. See what happens then here. Look at this case. Only focus on ninth row. What is the return here? I want you to speak out. What is the return here? Speak out. 14%. What is the risk? When the correlation is 1, not 1%, 1. Why here for the same amount of return, risk is less? Can you see here? Return is still 14%. Why risk is not this, but this? Can somebody tell me? Because this time the correlation is nothing. There's no correlation. Hence, for the same return, risk drops because there's no correlation. Zero. They're completely uncorrelated. The stock price of socks making company, and then the price of some digital software. No correlation between them. You can have some extreme example. Yeah, Nadia, what do you want to say? Yeah, yes, they're separate examples. In one example, the correlation is 1. In this example, the correlation is 0. Now see what here, risk again goes up. Risk again goes up, but not that much. Not this much. Why? Because this time correlation is neither 0 nor 1, in between 0.5. And guess what? The correlation, the risk is the least. Why? Because correlation is -1, perfectly negatively correlated. For example, I gave you a fictitious example of the oil price and the gold price. So when the correlation is the least possible, then for the given amount of return, your total risk drops. Are you with me? The same is for B combination. The same is for C portfolio, D portfolio, E port. Whatever portfolio you choose, the risk would be the least here and the highest here, and in the middle somewhere here and somewhere here. But the highest risk for every portfolio would be C column, and the least would be I column. Okay, and why these risks are changing, by the way, because that shows your risk appetite. Some people want to go for more Y portfolio. Why? Because they want to go for more returns, but then they are facing more risk also. But the question is that further depends upon what is the correlation between the stocks. See, when you see this, you have the least risk at E. You choose this situation, this situation, or this situation. The risk is always the least in the 13th row, whichever portfolio, because then you give more weight to X and less weight to Y. But when you compare vertically this, and this, then you see that risk is always higher when the correlation is higher, and risk is always less when correlation is less. This is why. So we learned a very important message, that diversification per se is not enough. If you want to satisfy, remember, when you become as a financial consultant, most of your clients would be, believe me, risk averse clients who hate risk. Okay, they would like to know, they will not only like to have the least risky portfolio, but they would also like to have those 2 stocks in the portfolio who have the least possible correlation. You get my point? Yeah. That's the message we learn from this story. That not just if somebody comes to me and say, Shab, I'm a risk hater investor. Give me a combination. Make a portfolio. If I'm not sophisticated analyst, I would say, okay, put all your money in X, because here risk is less, because return is less. But then if you ask me the next question, what is the correlation between X and Y? Goodness gracious me, I don't know that. It means that my knowledge is not complete. And when I see different correlation coefficients, then for the same amount of return, the risk keeps changing. Okay, and when I plot all these points graphically, this is what it looks like, right? This is what it looks like. So, so what we learn from this exhibit is that people who are risk lover, they can accept a lesser level of return for a given amount of risk because they can choose to have highly correlated stocks. On the contrary, if you look at the blue line, which is the top most, it shows that if you are an extremely risk averse investor, then you expect higher return for a given level of risk. And in between, the green and the red line shows some kind of risk neutrality, you know. So this is the idea behind this picture. That correlation, look, what we see here, I have explained you three concepts here. Averages, which is the mean, standard deviation, correlation. This is what we learn in statistics, isn't it? It's not the main, these are not the financial concepts. But look, you are applying those concepts in the real life. So this finance is the application, is a kind of playground where you can apply all those conceptual knowledge. So not only you're learning finance, but you're also learning the application, the applied side of statistics. And once we go deeper into and deeper, which we will go, you will learn more statistical concept, regression, and all those kind of things getting used into finance. Okay. I take it. The next thing which I want you to discuss with you is about, remember I used the word standard deviation is a measure of total risk. And you studied by yourself that total risk is a combination of systematic risk and unsystematic risk. And the question is, how can you take away, how can you decompose, how can you separate systematic risk from total risk? When you say that total risk is equal to systematic risk plus unsystematic risk, and then I say that total risk is measured by the standard deviation, as we studied in the example of those football teams. Are you not interested in knowing how to separate systematic risk from total risk? If, for example, I'm your potential client and you are running an investment company, you are giving consultancy, and I ask you, hey, which portfolio is the least portfolio, least risky portfolio? You say that this is the least risky, and then I say that, can you tell me what is meant by riskiness? And you say that, you know what riskiness means, the risk which come within the company and come from outside the company. And then I say, which one, can you tell me from this risk, which one is coming from the company itself and which one is coming from outside the company? And you will say, he's a tough client, he's a difficult customer. So it means that the next thing you should know is that how to separate systematic risk and unsystematic risk from total risk. How to decompose the two components of risk from total risk. That's what we're going to do now. And when you talk about the systematic risk, then we need to know that systematic risk is measured by a coefficient called beta. Beta or beta, whatever you call it. I call it beta. It's a beta coefficient. Beta coefficient is measuring the impact of the market movement on the stock movement of an individual company. Beta coefficient. The beta coefficient is a measure of systematic risk, and it shows the impact of the market risk on the risk faced by the company. So basically, if I redefine it, systematic risk or the beta coefficient tells you how much market risk a company is exposed to. You get my point? Or should I repeat? The beta coefficient tells you how much market risk an individual company stock is exposed to. It shows your risk exposure to the outside world. How much you expose to the market. And this generally, the beta, remember here is a bit deviation, bit difference. Your correlation can be the least -1 and the highest +1. It's more standardized, the range. The correlation could never fall below -1 and could never go beyond +1. But for beta, this is not the case. Beta could be as high as anything. Yes. Is exposed to. The company stock is exposed to. Okay. To know beta, we need to know a little bit of mathematics. Maths you studied in your 6th standard, 7th standard. When did you study maths? Which year you were in 6th or 7th standard? Don't forget one thing, that beta is the slope. Slope, right? Now I just play with the numbers now. I want to show you an example. Imagine I have two. I'm taking very less data, which is not real, but in the template spreadsheets, you have even last 20 years data. I would show you later on, but I just want to take some simple case. Let's say Marks and Spencer. Which country Marks and Spencer is? In which stock exchange Marks and Spencer is incorporated? In UK, in London Stock Exchange, and it is represented by FTSE 100. Let's say the index, the market, the top British companies. Let's say the stock price is 12, 13, 13, 14, 21, 22, and FTSE index is 1,000, 1,100, 1,050, 1, 2, 3, 2, 1,600, 1,700. Okay, so here a company is a member of the market. Look at the cursors. This is the company's stock price, and this is the market index value, the full market value. Okay. What should be my first step? What should be my first step here now? To get beta, what do I need to get? Change in what? Uh-huh. Do we use the absolute stock price or do we take the return? And let's the dates are. Let me find the dates also so that you know what I'm doing. This is 18th September, 17th September, 16th September, 14th September, 12th, 11th. It means the data is in the descending order from the newest to the oldest, right? That's very important. Otherwise, your calculation can be upside down completely. It's very important that which is the latest time. Yeah. Now, this is M&S stock price. Stock price. And this is FTSE 100 index value. First of all, please tell me, should we do the calculation with the absolute price or with the return? Do we calculate performance based on return or price? Return or price? Always return. Always return, not price. Now it's clear that return matters, not the price. Return is a comparative measure, a relative measure. Price is an absolute measure. Absolute measure is that which is preceded, which starts with some physical unit like dollar sign, like pound sign. Return is always a coefficient or a percentage without any physical sign. All right? You will never say return is 5 pounds. You will say return is 25% or 0.25. Okay? Make sense? Okay, the first thing you should do is you calculate M&S what? Return. Then you need to know, is data in the ascending order or in the descending order? Descending means from the newest to the oldest. Ascending means from the oldest to the newest, to the oldest to the newest. Here, look what I'm going to do now. Equal to bracket. Bracket is very important. Otherwise, this number formula would be complete mess. The current price minus previous price, bracket closes, divide by the previous price. There we go. And if you click here, this, because the previous number doesn't exist, this is useless now. So this is the return. And this is exactly what I did here. How do I get? Can somebody tell me? How do I get 25%? The current price minus previous price divided by previous price. And then, of course, if I multiply by 100, it gives me percentage. But it still gives me 0.25. All right? Make sense? So how we calculate the return is the current price minus previous price bracket. If I don't use, see what? If I don't use this bracket, what will happen? Is 25 minus 20 divided by 20. I don't know what that is. that would be unpardonable. That's why we use bracket scale. Now, to get this return, I need 12 September price and 11 September price. Look, to get F9 value, I need D9 value and D10 value. Yeah? You agree or not? Yeah. I'm in 12th September. If 12th September is current, then 12th September is current and 11th September is past. Right? Nadia? But problem is that if I'm here in 11th September, I don't have the data of 10th September. If I have it, then I would have it. But I don't have it, so I don't have it. All right? Make sense? Yeah. And then we find, is it going on? Yeah. And then we find FTSE 100 return, yeah? Okay? The logic is same. The current index value, minus the old index value, bracket closes, not divided by, bracket closes, divided by the old value. And then if you find here, can you see suddenly that it become plus sign? Just click it, it goes all the way down. You don't have to go, or you can drag it, but if you have 20 years, dragging can take long time. If just go in the corner, plus sign, click, goes all the way down. Once again, the last value is redundant value. Nadia, because we don't have 10 September's data. And then, am I missing something? Oh dear, before it goes off. How do we measure beta? Can somebody tell me from the previous? No, slope. Slope is a measure of beta, systematic risk. So what you do here is equal to, watch carefully what I'm going to do. Type slope. Do you see slope? Yeah. Slope, first, the company stock return, separate by semicolon, the market stock return, enter, beta is 1.08. This shows the systematic risk. I try to arrange the battery. Where do I go now? Does it show? Yeah, it's better now. Yeah, it's working. It shows here the beta is how much? 1.08. I click it. This is how the beta looks like. Look, you said, Nadia, you just said that beta is change in Y divided by change in X. Look, F5, F9 are showing the company stock return. F5 to F9 shows the company stock return. Then divide by means semicolon. And then divide by what? Market stock return. And what is market? G5 to G9. So basically, I am exactly following what mathematics is saying. I'm following mathematics here, exactly. And what I get, beta 1.08 or 1.09. Yep. Slope. Slope or beta? This is a beta. Beta is the measure of systematic risk. Remember, who is the measure of I should have asked, who's the measure of total risk? And I said, who's the measure of standard deviation? It shows that I need coffee as soon as possible. Standard deviation is the measure of total risk. Beta is a measure of systematic risk. Difference between the two will be what? Unsystematic risk. There you go. Okay? Sound sense? Yeah. Just slow, simply. If you, yeah. You mean in there are many files showing beta, but if you want, I can show. I can put it. Okay, I can. Let's save it. Yeah, have you seen it? So let's call it beta basic. Let's call it save as let's call it beta basic. Beta basic. And then I can upload it in Optima, spreadsheets, file, browse, desktop. Where is beta basic? Here we go. Beta basic. Proceed, access. You all have. Okay, now this file is in Optima. Beta basic. So this would be a very good starting point. Before you deal with thousands of observations, it's good to practice with a very simple basic, beta basic. Okay? Are you all right? I'm coming on that. I'm coming on that now. Because it should be recorded. How much is beta? Can I call it 1.08? This 1.08, now listen carefully, the interpretation, that's why I'm saying that calculation, it's not an Excel course. Everybody can do it, but the main important thing is how you draw decisions, inference, interpretation. The interpretation is that when in FTSE 100, the whole market, the stock return goes up by 1%, Marks and Spencer stock return goes up by 1.08%. Good finance, bad finance. When in the whole market, the stock return goes down by 1%, Marks and Spencer loses 1.08%, which is more than 1%. So you gain more than the market, you lose more than the market. Hence, if beta is more than 1, then your risk exposure is more. Yeah? Who likes more risk exposure? Which investors like more risk exposure? Which investors like more risk exposure? Who? Risk lovers. Hence, if beta is more than 1, this stock is meant for risk lover investors. If you are a risk averse investor, stay away from it or give very less weight in your portfolio. Okay? If you are a risk hater, risk averse, either stay away from, in this example, Marks and Spencer, based on hypothetical data, or give very small percentage in your total portfolio to Marks and Spencer. The question is, where do we, is any kind of threshold limit? Well, there's no real limit. I would say it's my own way of thinking. that if you are a risk hater, risk averse investor, your beta should be below 0.8%. My own assessment is that if you hate risk, your beta should be below 0.8. No, it's not percentage, it's coefficient, 0.8. So if the beta is 0.8, less than 0.8, I think this stock is good for risk haters. And anything between 0.8 to less than 1 or equal to 1. So anything between 0.8 to 1, exactly 1, risk neutral investors. And anything beta more than 1 is for risk lover investors. So this is my own kind of structured threshold limit. So 0.8 is a benchmark which divides between, is a border between risk neutral and risk averse, and 1 is between risk lovers and risk averse investors. Okay? Sorry, risk neutral investors. Yeah. So anything above, so this, in this case, your beta is more than 1, hence it's more appropriate for risk lower investors. Okay? We shall carry on next week now. Next week, don't miss out. Next week, I will only and only focus on spreadsheets, basically, and how we start doing calculations. Okay? Less concepts now. I can say with confidence that I can see from your participation in the class that you know most of the concepts so far. But next week, we shall be dealing with the real data, right from downloading to putting them in the spreadsheets and doing the analysis. Okay? And make sure that you all have access to computers next week. So bring your own laptops, please.